Good morning to you and you and you. Good morning. I have a couple more shares going out. How's everybody doing today? You doing good? Hope you're doing good. Oh, Lordy, it is a Monday and we have the markets up. I'm sure everybody saw that, right? That's cool. But maybe they're just up because we're printing a whole bunch more money. Money printer go brrrr. But not in the cold way. It should be frozen like brrr. Need to freeze that money printer, boys. It's getting out of control up in here. It's getting wild. You know what I'm saying? Bam. Thanks for the 99 Super Chat sticker. Let's get into it. Hit that like while you're at it. Good morning and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. Today, we're going to be talking about ETHW. What is ETHW? It's basically a projected fork of the Ethereum blockchain during the merge. As some of you may know, of course, the merge is coming up in September, so this is a super relevant topic, and we have a ton of stuff to cover regarding it. So we're going to get into all of that. We're also going to be talking about 51% attacks on other networks and how much that may cost on NiceHash. We are also going to be talking about Vitalik's response to ETHW, as well as a couple more minor newses. Crypto miner Mawson says CFO resigns. And after countless bungles, Compass Mining tries to change course. And then we have a new GPU benchmark release from Intel, their Arc A380. Specifically, this is going to be the ASRock Challenger model. Probably one of the worst models if I had to take a bet, because the Challenger model lineup from ASRock has been absolute garbage here for the past couple years, in my humble opinion, since the 5000 series. But we're going to get into all of that and more right after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. And welcome back, ladies and gentlemen, boys and girls. Let's hop into the first one, which is ASRock Intel Arc A380 Challenger ITX graphics card benchmarked in games in 3D Mark. ASRock's newly launched Intel Arc A380 Challenger ITX graphics card has been benchmarked in several games in 3D benchmarks. Launched last week, the ASRock Intel Arc A380 graphics card is a small form factor solution for the ITX segment. The GPU is based on the Alchemist ACM G11 SKU, featuring 8 Xe cores and 1024 ALUs. The card comes with a rated 500 watt power supply requirement and features a single HDMI 2.0B and 3 DisplayPort 2.0 ports. There's 6 gigabytes of GDDR6 memory, which is the highest we have seen on this gen's entry-level cards, and since the whole thing is designed around the ITX form factor, it measures 190 by 124 by 39 millimeters. Obviously, that is intriguing coming from the mining perspective. An entry-level GPU with the most amount of memory, 6 gigabytes, which should fit all of the DAGs that you could ever want, except for, of course, I believe one, which is either Cortex or Conflux. Let me know in the comment section below. I think one of those is technically above 6 gigabytes, but the rest are good to go. ASRock decided to test the card itself, and we can see that while the card features an official clock speed of 2,250 megahertz, the GPU is actually running at 2,450 megahertz within the firm mark stress test. The chip produced a maximum temperature of 78°C, which is decent considering this is a conservative cooler with a singular fan and a small heatsink under its shroud. The A380 Challenger ITX graphics card was tested in various games and 3D benchmarks. You can see the results below, so let's hop into those. We have a TDP of 92 watts and a single 8-pin connector, which is pretty nice. And scrolling down, let's see if we can figure this out. It's hard to tell what all of these games are. I'm going to assume this is Cyberpunk 2077 at 47.5 frames a second. I'm going to assume this is CSGO. Oh, wait, it actually says CSGO at 160 frames per second. And this is at 1080p. So you could get, a full 144 hertz panel on CSGO if that's what you're looking at. Or, of course, Dota 2. You have your Apex Legends at 91 frames a second. Not too shabby. Gaming numbers are also provided in various titles, which showed the ARC A380 delivering over 60 and 100 FPS in most esports titles at 1080p, clearly, which is the target for this particular GPU. Looks like we have the Time Spy, score here of 4,668. Not looking too great. I would be curious, though, on essentially the mining performance. However, I don't expect much out of it either, because while we are getting 6 gigabytes of GDDR6, which can fit full DAGs, all that sort of thing, the memory speed is pretty slow at 15.5 gigabits per second, and the memory bus is only 96 bits. So it's really going to come down to, basically what price point this comes in at for whether or not it's worth it. I'm going to lean towards probably not worth it for mining. 96-bit bus is quite tiny and the memory speed is quite low. More mining news, though. After countless bungles, Compass Mining tries to change course. The company that set out to make crypto mining available to retail investors has had to put out its own fires. Finally, more on Compass Mining. We had this snafu a little while ago where they had a facility shut down. I tried to get the news, but apparently the guy that handles their PR doesn't even know what was being hosted in that facility. So, it is what it is. In its quest to make industry-grade crypto mining accessible to retail investors, Compass Mining may have overreached. After a couple of years of growing exponentially, the firm is slowing down and focusing on its core business. On June 28th, the CEO and Chief Financial Officer of Compass Mining resigned amid a series of setbacks and disappointments, including delays in deploying machines and several thousand rigs being stranded in Russia following sanctions on its hosting partner in that country. The new management then cut 15% of its staff, mainly in marketing and business development, and is now trying to move away from a growth mindset to focus on the core parts of the Compass business. Quote, "In hindsight, you wish we had done certain things differently. But in the moment, you got to be realistic about what information is available to you and make decisions accordingly," said Thomas Heller, who will be leading the company. The two new interim CEOs and co-founders are indicative of Compass's new direction. Paul Gosker, formerly the Chief Technology Officer, and Heller, who as head of mining spent more time in the nitty-gritty business of building mines, are more the back office types than Whit Gibbs, the CEO and third co-founder, who resigned and who was more of a charismatic executive. Heller told CoinDesk that he is supportive of recruiting a more seasoned CEO to lead Compass and to bring a new perspective and experience, but the new leading duo is also open to staying on. Compass is one of a handful of companies trying to bring Bitcoin mining to the masses, despite the industry's gravitational pull towards bigger firms, investors, and mining sites. The company does its part to support the network's decentralization by enabling individuals to mine, its website says. Now, I don't think that renting space or hosting in general helps decentralize the network. Reason being is if you are renting out space, you are putting all your Bitcoin miners or your miners in general into a singular location. The idea of decentralization would be spreading the hash rate across multiple locations. Now, in theory, it does help the decentralization of the actual block reward because you would go out to more people. So I guess the currency itself, the holders of the currency are spread out more and it's a little bit more decentralized. But if we're talking about from a security perspective and the amount of hash rate on the network coming from a singular location, it's less decentralized. So, you know, I'm not quite sure that I hop on board with that kind of PR talk when Compass gets into the whole to help people be more decentralized or help it be more decentralized. I don't agree with that. It's an ambitious, if not noble goal. I don't think so either. It's not an ambitious, I mean, maybe ambitious. It's not noble. I mean, basically, they're trying to make money like any other company, so let's not get that conflated with anything. The company's recent setbacks pose a serious question. Is the model everyone can mine Bitcoin untenable, or is it an indication of misfortunes and mishandlings particular to this one firm? And can Compass Mining set sail on a new course? Those are all good questions. I think, like, if we talk about mining cryptocurrency and Bitcoin in general, one of the things that we always say, just to clarify, get out of the way, of course, is not your power, not your miner, meaning that if you're not paying the power bill directly or you are not hosting it like within one of your own facilities or in your house, technically it's not your miner, because at the end of the day, you run into the same centralization problems, not dissimilar to if you purchase cryptocurrency on a centralized exchange. And that is primarily the fact that you don't have any control over whether or not that miner stays up and running, right? And for how long it stays up and running. Now, I get that a lot of these companies are going to put in some sort of hopefully some sort of protection for the purchaser of the miner and the hosting services in the case that, you know, the facilities go down and so on, but that's never guaranteed, right? And if you get into a position where one of these companies is struggling significantly, you have a lot less of a likelihood of that maintaining or that contract being maintained. And there's probably some sort of protection in there for them, if I had to take a guess, in the opposite direction, meaning if the hosting facility goes down, more than likely in the contract, they're protecting themselves before they protect the end user. But I am not certain in this particular model with Compass Mining how they have that written up. It would be something to look into, though. So if you are going to be looking at hosting facilities, etc., make sure that you are paying attention to what's in the contract, what happens if their facilities go down, and also what happens if they destroy your miner, right? What if they have a power surge or the mining facility catches on fire and your miner is damaged and no longer operational? Are they going to replace it? These are all the questions that come into play if you're not going to be controlling, you know, your own machine. Compass is essentially a middleman. It enables retail customers to buy machines and hosting services. For the mining rigs, it divides bulk orders to manufacturers in small pieces under the terms of service. Retail customers will own the mining rigs without taking on the responsibility of plugging in or maintaining the computers. For the most part, Compass doesn't operate its own crypto mines. Instead, it works with hosting companies that take care of setting up and managing the infrastructure that the rigs operate in. So here's another interesting note about Compass in general. The actual mining farms, which we learned, of course, previously, the hosting facilities, and we learned this when the hosting facility went down previously, they aren't owned by Compass Mining. So all they really are is a broker in between the people trying to rent hosting space and the actual hosting space itself, which is kind of interesting, but that should be noted. It lists 39 such hosting facilities across the world on its website, mainly in the US and Canada. Hosting is a service that data centers provide to crypto miners so that customers can store their mining rigs and mine their preferred digital assets for a fee without having to build the accompanying infrastructure themselves. Compass also operates a platform where suppliers and hosting firms can buy and sell machines in rack space. Heller wants the company to focus more attention on developing this platform and on improving transparency through technology and real-time data. The company was founded in 2020 and grew to serve 11,000 customers, according to Gibbs, the former CEO. Heller said later that Compass counted 7,000 customers and that this past spring before layoffs, it employed 100 people, up from 12 in April of 2021. So from 12 to 100 people. Now they fired 15%. So I suppose that means they have around 85 people remaining or something along those lines. Two services companies that worked with Compass, one from Sabre 56, told CoinDesk that Compass was professional and that they had no issues working with Compass. But the publicly facing image wasn't the whole story. One former employee told CoinDesk that lots of things are very poorly managed and executed on, which gives people the perception that they're shady. The employee didn't want to be named because of non-disclosure agreements. Heller said that internally the company is fast-paced and operates like a startup. It isn't like a big established corporation with standard practices and flowcharts. Heller said the company is now taking more time to make strategic decisions than it did before. Compass operations have been plagued by delays in delivering its promises and by what many customers see as a lack of transparency and communication. At least 4 of Compass's sites have suffered from downtime or delays in deployment, leading to losses for customers. Those hiccups angered lots of customers. More than 500 customers have taken to a new Discord channel to voice their woes and organize so that they can better deal with difficulties. Customers who CoinDesk spoke to requested anonymity because some are contractually obligated not to talk about their dealings with Compass. And that is a red flag to me. I didn't really actually know this was happening. It'd be interesting to get in this Discord. Maybe we should have some people digging in and figuring out exactly what's going on there. It's funny because we read about a lot of these things that happen within cryptocurrency that put customers or clients and that sort of thing in a very sticky position. It's nothing that I've ever participated in necessarily, right? So I didn't have to deal with, like some of you all did, the Celsius issue, because from the get-go, I just looked at it and completely ignored it because I was like, oh, my head kind of when I look at stuff like this is, does that look good? No. Kick it out of my head. I don't need to pay attention to it. And I do need to pay attention to it a little bit more so that when these things do happen, I can warn you guys a little bit better, other than, just kind of pushing it off to the wayside. So apologies there. I definitely want to report on this type of stuff more. Unfortunately, this is one that I think a lot of other crypto miners on YouTube also promoted. And so I know that because we have crossover audiences and so on, some of you all are probably caught up in this, not dissimilar from some of you all being caught up in Celsius. And that's, to a certain extent, I feel responsible to let you guys know when things like this are not a good idea. But we can kind of just hammer home the same principles that we always do. Not your keys, not your crypto. If you don't control your keys to whatever investment you're doing, think twice at least. Probably think 3 times or 4 times, or do like me, don't think about it at all and just say no. That's one thing. The other thing is for the hosting, I would consider in general, being extremely careful with hosting. If it's a large company that has multiple clients, you need to make sure you are reading those contracts because clearly they are under contractual agreement to not even discuss their dealings with Compass Mining in general, which means that you could be in a really poor position with Compass Mining right now and not legally feel like you're able to talk about it, right? If anyone is in this position and wants to leak any information to me that they have surrounding it, you can email me at inquiry@sonofatech.com, which is also on the About tab here, and we can get it covered for you to the best of our ability. 3 industry insiders that CoinDesk spoke to said that the company grew too quickly for its own good, and Compass's new management agreed with the assessment in its blog post while announcing the layoffs. Heller said the reason the company grew so quickly is that it was filing a niche market that people had tried to fill before, but have never evolved from a small-time brokerage into a platform where customers buy and sell machines and rack space on the website. Along the way, there's definitely things that we could have done differently, like focus more on the real core of the business, which is selling machines and keeping customers satisfied, Heller said. Phil Harvey of Sabre 56, a company that builds mines around the world, including about 5 for Compass, said that typically a hosting firm will deal only with Compass, but that Compass has, as a middleman, could be confronted with as many as 1,000 angry customers with 1,000 different machines. And those machines are spread across apparently 39 hosting facilities. So we do have to give Compass this break, right, to a certain extent. I don't think that Compass in general is doing something malicious, right? I want to make that very clear. I think that they have good intentions, but A, they grew too fast, and B, they were spreading themselves so thin that it's hard to manage any of that, right? And I don't know what kind of like client management software they use or anything like that, but documentation, all that stuff is going to be paramount because you are going to have just too many miners with too many customers across too many hosting facilities, and it's going to put you in a pickle, right? And that's just the way it goes. The promise back in 2020 was to allow retail client to host at the most respected facilities in the world. It turned out to be a tall order to find rack space for 30,000 machines. By contrast, a similar company, Mining Syndicate, which started selling mining rigs and hosting last October, has fewer than 600 clients, Chris Corner, founder and CEO, told CoinDesk. Heller admitted that Compass worked with some newish hosting providers that had built out only a few megawatts of mining sites. If not for the explosive growth and if not for the rack space constraints, we would have most likely just stuck with more seasoned operators, he said. Harvey said that common problems such as machines overheating can spiral out of control very quickly when the parties involved aren't experienced enough to solve them quickly. Here's the thing too, though. You can't really solve it extremely quickly. I've been dealing with heat issues. We have one of the hottest summers, actually probably I think it's technically the hottest summer that we've ever had in Texas. And these are just problems you're going to run into. And yes, if you have like a host, if you're hosting for somebody else or you are renting out, like that's going to be a big issue. And you have to basically get into the position where you're going to be able to cool that actively. And if you're trying to cool actively, you're going to spend a lot more money. And if you're spending a lot more money, but you put yourself in a position where you have locked in, hosting fees, you may be in a lot of trouble. Not dissimilar for trying to remain profitable yourself, except it's a little easier yourself because you're going to be able to bob and weave through that or shut some of the miners off depending on your situation. If you're renting it all out to a bunch of people, you can't just shut it off to reduce heat. Compass has sued at least 2 of its hosting providers for failing to deliver what they promised. The first lawsuit is against Xenon Management in Texas courts. The suit was filed last December. Details are scant in a court document that CoinDesk reviewed, and Xenon did not respond to a request for comment. Heller said that Compass found some red flags while doing due diligence and stopped working with Xenon. But he refused to comment on the specifics of the ongoing litigation. The second lawsuit is against Dynamics Mining, a company that was building a Bitcoin mine for Compass in Maine. In the lawsuit, which attracted a lot of eyeballs on Twitter, Compass claims that Dynamics has failed to deliver on its contractual obligations and is holding its mining rigs hostage. Compass gave Dynamics $1 million in loans to build out 2 facilities on top of hosting fees and deposits totaling $650,000, according to court documents seen by CoinDesk. Making such a loan to a hosting provider was very uncommon for Compass, Heller said. On the other side, Dynamics claims that Compass hasn't paid its $861,000 in hosting fees and electricity charges, and accuses Compass of trying to break into Dynamics mining facilities in order to steal the mining rigs. A court partly granted Compass request for a restraining order on Dynamics. That allowed Compass to retrieve all of the machines as of July 29th, Heller said. Customers could choose to have their machines shipped directly to them for a fee or hosted on a new site after the rigs are serviced at a Colorado facility, according to an email seen by CoinDesk. Oof, that is, what decision do you make there? Do you continue to allow Compass to host your mining rigs, or do you just have them ship it back? And in my humble opinion, there shouldn't be a fee for shipping it back at this point, but it's probably super expensive to ship all of those mining rigs back to the owners. Despite the turn of events, Dynamics Mining gave a free Bitcoin mining rig and hosted one of a handful of parties at the Mining Disrupt conference in Miami in late July. Mining consultant Harvey also thinks that Compass gets a bad rep because it has so many retail customers and is outward facing. Delays in sites or unexpected downtime are common issues in the industry, even for giants like Marathon Digital. But Compass has such a large and prominent PR presence that such issues are more widely publicized, he said. And that's the thing, you can't overpromise to the customer if you don't already have those mining facilities locked down and confirm that they're going to be functioning well. And, yes, okay, they get more heat and flack than a miner that doesn't rent out hosting to retail. But I mean, that should be expected, right? You have to perform more due diligence than your competitors that are not performing, the same services. Corner said that he has a lot of empathy for Compass because mining is a very difficult business. It is really, really hard to run both a miner sales business and a hosting business at the same time, he said. It's especially difficult, and then you do it to retail clients that are brand new to this industry. It's just logistically challenging. I agree. For retail investors, the situation was stressful to say the least. People had their savings in there, and they are uncertain what will happen with the miners, one customer said, adding that more recent news about miners offloading their Bitcoin and potentially having under-collateralized loans only heightened their concerns. Compass has, in the past, flip-flopped on its statements. When CoinDesk spoke to Gibbs, the former CEO, on June 24th, he said that Compass had never had layoffs and that Compass was in a good position to continue to serve its customers and to focus on growth. That was before new management decided to lay off 15% of the workforce on July 7th. Serial numbers of the machines it sells is another issue. The terms of service from last September that CoinDesk reviewed said that Compass had to provide customers with their serial numbers of the machines within 3 days of their requests. But a newer version from March has scrapped the time limit for Compass to satisfy the request. Several people on the Compass Discord channel complained that they were ignored when they asked for serial numbers. One said that he was waiting for around 2 weeks for the serial numbers, which would enable him to track the machine. Otherwise, Compass would send it after it was deployed, the customer said. Asked about the change in the terms of service, Heller said, truthfully speaking, having a 3-day window on providing serial numbers is just unrealistic. That's kind of odd to me. I think that it's not completely unrealistic because you have poor management software is what it sounds like to me. It sounds like the process and the management software you guys are utilizing to basically facilitate all of this is not serving its purpose. If you are going to be selling a mining rig to someone, it should be as simple as, okay, this one's in inventory. We already tracked, we had somebody go and pull the serial number. That's all in the system. Click, click, boom. The serial number is there on the day of purchase. It seems to me that they are selling rigs that they do not have in stock, and they are selling mining hosting or hosting space that they do not have available, and that is where the issues are coming into play. Given that there are limited resources when setting up the mines and that in some cases deployment has already been delayed by the time the machines have arrived at the site, the priority is to get the rigs running and then send serial numbers to customers, he added. And that is just ridiculous. If you are unboxing, you should just have a guy that is pulling the serial numbers as you unbox them. This would be unacceptable in any other IT industry in the world. Unacceptable. You cannot deploy a server without giving the customer the full information of that server. I worked in this industry. I know exactly how it functions. That is, at a base level, for somebody that is installing the hardware, a fireable offense. That is just the end of the story there. The company mainly cut down on marketing and business development staff, which Heller said wasn't exactly essential to deliver machines and hosting. Compass had poured resources into creating educational and marketing materials for its retail clients, publishing insights that CoinDesk frequently references. In their July 7th blog post, Heller and Gosker promised to spend more time doing due diligence on content providers and working with those with high integrity. Heller noted that the comment wasn't directed at any one particular partner. One customer, who chose to remain anonymous, said that he first heard of Compass through influencers like Peter McCormack and Anthony Pompliano. Brings up some very serious questions for me that we'll talk about later. None of the influencers responded to CoinDesk's request for comment. Some content creators have broken off with the company prior to this summer's revelations. On June 27th, before the announcement of the management changes, influencer Dennis Porter, who had signed on as an executive producer with Compass on March 22nd, said the two ended their collaboration on Twitter Spaces. Mitch Klee, who was mining analyst with Compass, also appears to have left the company based on his Twitter bio as of July 7th. But perhaps the biggest difference on what the advertised versus what happened had some element of force through these sanctions on Russia. Compass had a big operation in Russia with $40 million worth of equipment, or 10% of the company's total hash rate at the time. Gibbs told CoinDesk in an interview prior to his resignation. Soon after the war in Ukraine broke out, then CEO Gibbs assured customers on the Compass Discord channel that it was business as usual and there was no reason for concern. Gibbs gave customers the opportunity to move their rigs out of Russia at an additional cost, but Compass wouldn't be able to host them at different facilities, meaning customers would be losing money on downtime. On April 20th, the U.S. Office of Foreign Assets Control added Compass hosting provider BitRiver to its list of specially designated nationals. Barring U.S. companies from doing business with BitRiver. That development came as a surprise to many because it was the first time a Bitcoin mining company had been sanctioned by the U.S. government. Compass had been unable to access the machines and couldn't communicate with BitRiver, Gibbs and Heller said. A BitRiver representative, however, told CoinDesk that it was Compass that was refusing to communicate. Despite our numerous calls to resolve issues that Compass mining customers have regarding equipment, we have found that this company reluctant to deal with and solve this problem, a BitRiver spokesperson told CoinDesk. Compass Mining refused to communicate with us and unfortunately refused to deal with the return of the equipment, the spokesperson added. And that's interesting, right? Is there sanctions around the equipment getting returned and BitRiver sending them to return them is kind of interesting here. So according to messages on the Discord channel, BitRiver told customers that Compass Mining didn't give BitRiver a master list of which machines belonged to whom prior to the sanctions. And so the Russian firm couldn't coordinate with individual customers to send back the machines. When asked by CoinDesk, BitRiver didn't comment on the existence of such a list. Later, Omar Todd, a customer who is organizing a response to the Russia debacle, told CoinDesk that Compass did send BitRiver a master list, but that the Russian firm either never received it or didn't act on it. Dissatisfied by Compass's handling of the Russia situation and seeing no light at the end of the tunnel, a group of customers have banded together to hire lawyers to get their machines back at the cost of $100 per machine. We're hopeful that both sides are well-intentioned, but soon actions will speak louder than words, Todd told CoinDesk. Being an unsanctioned party representing many Compass customers with miners stuck in Russia, we should be able to find the right solution without breaking any sanctions, he said. Veribuy, a firm that bought $1.5 million worth of mining equipment to be hosted in Russia, has filed a lawsuit against Compass, claiming Compass failed to secure the miners when the war broke out. According to lawsuit documents, BitRiver has refused to work directly with Compass customers because, in its view, their equipment belongs to Compass. In its lawsuit, Veribuy claims that the true relationship between Compass and BitRiver has been concealed. In fact, it is far more plausible that Compass's relationship with BitRiver is other than the simple agent-provider relationship represented to Compass miners. The complaint filed in a California court reads. The sanctions on Russia do not prohibit the recapture or demand for return of property under the temporary control of a sanctioned entity, as the lawsuit writes, said Justin Newton, a co-founder and CEO of Netkey, a company that is working on digital identity products for anti-money laundering and sanctions enforcement. If Compass was obligated to compensate BitRiver for the return of the mining rigs, that may be a different story, since sanctions prohibit U.S. companies from transferring value to sanctioned foreign entities. But other than that, Newton said he couldn't see a good reason for Compass not to repossess their equipment unless they are financially unable. On the other hand, Ari Redbird, head of legal and government affairs at crypto compliance and risk management firm TRM Labs, said that dealing with a sanctioned entity is complicated, and that Compass likely will be looking for a license or at least a thumbs up from OFAC before engaging. Last summer, after China banned crypto mining, Compass started selling bundles of mining rigs to customers, promising them future hash rate. The firm then used those deposits to buy the rigs and build the hosting sites. Under this model, customers had to foot the bill for their sites' build-outs, while Compass was managing the process. One way the Compass did that was to sell bundles of rigs, averaging a predetermined amount of hashing power, which would be gradually online over several months. The bundles cost anywhere from around $48,000 to $65,000 just for the machines, including $26,000 to $34,000 in upfront costs, according to marketing materials seen by CoinDesk. That was my biggest mistake, one Compass customer told CoinDesk about buying a bundle, because the opportunity cost turned out to be much bigger than he initially thought it was. Most bundles promised that the machines would start going online as early as February of this year, when mining profits were almost double what they are now. Now, this is not just a problem with purchasing from a company like Compass Mining. This is a problem with purchasing ASIC miners, especially in the West. You have a very sketchy kind of market for ASIC miners. That's why on the channel, whenever I do find, someone that is selling basically ASIC miners that actually ship, I make sure that they ship. I create essentially a relationship with the company. And then that is why we have only so far set up, 2 affiliate links for you guys, one at btminers.com and one at coastalcryptomining.com, which Coastal Crypto Mining, by the way, promo code SOAT right now, 5% off. But it's because, it's very easy to get burned right now with ASIC miners. Basically, if it looks too good to be true, it's definitely more than likely too good to be true. Heller said that Compass tried to procure backup rack space for the bundles and even had backup on backup, but hosting providers didn't deliver. Customers said the first 3 machines out of 6 they were expecting were more than 1 month late each. 3 customers told CoinDesk that they were told they would get refunds for their bundles. In July, Compass offered miners who bought a hosting plan for a Texas site to opt to move their machines to a facility in Georgia due to low uptime, according to messages on the unofficial Discord channel. Later, Compass said it wouldn't proceed with moving the miners because a recent rise in the cost of energy in Georgia would increase hosting rates, and because they want to honor Compass miners who deployed in Texas for tax purposes, according to messages on the channel. To Sabre56's Harvey, much of this is expected. Like any company, they're going to pass risk on to their client base, he said. Unfortunately, that's the story of retail investors, he said. They're always the last ones to benefit. So, what did we learn from all of this, though, at the end of the day? Building out hosting facilities is difficult. If you were going to run a hosting facility, you would want to have all of the power available and set some sort of limit, as well as all of the miners available and set some sort of limit that is what you have in your possession. You would have to perform extreme due diligence to make sure that you were able to cool all of that equipment, and it's extremely difficult to do. From a retail investor standpoint, you probably still want to avoid any sort of hosting company, unless of course it's something along the lines of you and a buddy going in together on a facility or something along those lines, somebody you trust, but be very careful out there. We have more crypto miner news. Crypto miner Mawson says CFO resigns. The company appointed Ariel Civikovsky as consultant CFO until a replacement is selected. Whew. Crypto miner Mawson Infrastructure said CFO Hitali Mahithia, give up, guys. I give up. Resigned to pursue other opportunities after just under a year with the company. The resignation takes effect on August 9th, they said in a filing, and the company appointed Ariel Civikovsky as consultant CFO until a replacement is selected. The previous CEO took on the role on August 19th, 2021, according to a filing with the U.S. Securities and Exchange Commission. In July, Mawson said it raised $10 million to provide balance sheet flexibility as crypto lender Celsius, the parent company of Celsius Mining, filed for Chapter 11 bankruptcy. The two had signed a 200 megawatt co-location agreement in March, which included a $20 million loan to Mawson in exchange for 3.85 million warrants in the mining firm. Only 54 megawatts of co-location were up and running at the end of June, and Mawson expected another 67 megawatts to be operational by the end of July. The firm has been raising money by selling secured promissory notes as well as offering stock. In the first quarter of the year, Mawson recorded a $11.6 million net loss, according to its quarterly earnings report. Mawson mined less Bitcoin in June than in May as the firm participated in demand response programs to help the electricity grid meet the growing demand. Civikovsky is CFO of Distributed Data Storage Solutions, a decentralized data storage provider on the Filecoin network. Australia-based Mawson owns about 20% of DSS, and Mawson shares rose about 5% in the pre-market U.S. trading, in line with other Bitcoin miners. So they didn't have any kind of issues there, but a CFO resigning is questionable, and you do have to bring into question what specifically kind of partnership they had with Celsius Mining and the state of Celsius Mining, which, as we know right now, is not necessarily that great. Let's get into the bulk today. The bulk of everything that is going on, because it is extremely interesting. So, Ethereum Merge coming up. What's the merge for the uninitiated? The merge is going to be the time when the execution layer is merged with the beacon layer, the consensus layer on for the beacon chain into, of course, basically at the end of the day, making Ethereum proof of stake instead of proof of work. Now, this is important because there is a ton of capital and a ton of miners behind essentially Ethereum as it sits right now, as basically the largest altcoin being mineable, and that is second to Bitcoin, of course. And the big key here is that a lot of people are also utilizing GPUs to do this. So here's the other thing. Mining, the way it works, right, is that there are different algorithms. So in a lot of cases, for the most part, people that are mining Ethereum are not going to be able to shift over to mining Bitcoin. Now, if they are GPU miners, they'll be able to shift over to some other algorithms because GPUs support multiple algorithms and there will be profitable ones. But if it's an ASIC mineable coin or an ASIC miner from Ethereum, then you're going to have more problems kind of shifting over. So this means that there will be a lot of money that gets kind of dumped out of the system potentially. And so now we have this idea of essentially another fork for Ethereum. And we're going to talk about it a little bit, but my thoughts in general at the end of the day is we already had one fork. We already have Ethereum Classic, and you could just move to Ethereum Classic. In my humble opinion, that would be the most, practical move for a lot of these large companies. And then the developers and everything can move to wherever the security is. But that doesn't seem to be exactly what's going on in the grander scheme of things. There's been talk of ETHW, or ETH proof of work, which would essentially be yet another fork and of Ethereum that would essentially happen probably right around the merge. And then you would have basically a split chain once again, and we would have 3 Ethereums now instead of just 2 at the end of the day. The benefits for this, of course, could be that you would have current development ready to go. All of the updates on Ethereum exactly as it sits will be ready to be on a proof of work chain. But the downsides are numerous, right? Like the thing is like most developers are going to maintaining their projects on the primary chain of Ethereum, which means you would just end up with a bunch of dead projects on proof of work, unless of course, something really bad happened to proof of stake and ETH went down. Then of course, maybe people would move over to proof of work. But for the most part, nothing would be maintained on Ethereum post merge for the proof of work version of the chain. So I don't see this actually working out. It doesn't seem to matter though, because what is happening is we have an exchange, and I want to warn you guys on this. This is one of those warning things. We have an exchange that is now advertising essentially ETH1 or ETHW as, a tradable asset on their exchange. And this is coming from Poloniex, or however you pronounce that. Here's the problem I see. But first of all, you can see here that it's already up for sale. As far as, you can go purchase it. It's pretty close to, this is the staked version. Let's go check the other one. Here's the work version. It's pretty close to parity. Is it, this one's, yeah. So this one's at parity, which is the staked version. And this one's not close to parity, excuse me. So it's about 10% of the worth of ETH for ETHW. Here's the thing. There's no public blockchain for this yet, okay? So if you're going into this exchange and you're purchasing ETHW or even ETHS, just to be clear, you run the potential of having 0 ETH at the end of the day, because there is no public blockchain. The fork has not occurred yet. They are pre-selling it. So if you go in here and purchase it, you're basically purchasing nothing. You're purchasing basically a line on a centralized ledger for an amount of something that doesn't exist. You're purchasing vaporware. I highly advise against it. While this is not financial advice, this is essentially don't get scammed advice. I highly, highly recommend against this. This is not something you want to go participate in. Is there potential for upside? Well, I suppose somebody could say that, you're purchasing it at basically a 10% discount, and there's a potential for you to basically 10x your investment or whatever it is. But the likelihood of that is extremely low. Even if ETH has a split, you are going to, at that point, then be able to record it on public transactions. So we go back to not your keys, not your crypto. This is an exchange, a centralized exchange. If you purchase it here, there is no chain for you to send it out to. So there is no verifiable public ledger for you to actually prove that you own it. And that is very dangerous. So I want to make sure that you guys are aware of what's going on there. Now, once again, I would also say, as far as all of this goes for a fork of Ethereum and one remaining proof of work, I do not think that that is the way forward. Why would we just go off on old, outdated, antiquated, technology when there are new chains that could use the support that are doing much better? Or even if you want to stay in the past, you have Ethereum Classic, which has updated to the point to where it is focused on proof of work, and its security has gotten better and better every day, and will only get better post merge because of more hash rate on the network. Vitalik did reply to this, and he downplayed it. He said, so this is an article from CoinDesk. Vitalik Buterin plays down impact of Ethereum forks after merge. Buterin said it's unlikely Ethereum will be significantly harmed by another fork. Ethereum co-founder Vitalik Buterin played down the impact of any hard forks on Ethereum after the network's merge event in September. Speaking at the developer event ETH Seoul over the weekend, Buterin said, "I don't expect Ethereum to really be significantly harmed by another fork. The blockchain planned to switch to a proof-of-stake mechanism, an event known as the Merge, next month, in a move developers say will make it cheaper, faster, and environmentally friendly." All of which doesn't appear to be playing out to be actually true, by the way. The change from a proof-of-work system will end an income stream for Ethereum miners who are rewarded with Ether tokens for their efforts. Miners produced over $620 million of worth of Ether in July alone, data shows. Tron founder Justin Sun has emerged as one of the most prominent investors supporting a hard fork to keep money flowing. Buterin said supporters of the proof-of-work consensus design shifted to Ethereum Classic when that network started in 2016 because it was known at the time that Ethereum would eventually shift to proof-of-stake while Ethereum Classic would not. Quote, "I think Ethereum Classic already has superior community and a superior product for people kind of those pro proof-of-work values and preferences," he said. Pretty much everyone in the Ethereum ecosystem is supportive of the move to proof-of-stake validation and quite united. I'm not sure that that is necessarily true either. But I do agree that Ethereum Classic does have, look, if your option is Justin Sun or the current Ethereum Classic developer community, I would go with the current Ethereum Classic developer community over Justin Sun. If I'm looking at that just based off of, the people running it or supporting it, right? I'll make that clear. Prominent Chinese miners like Chandler Guo have proposed a hard fork, so even as Ethereum undergoes the merge and becomes validated by stakers, miners could continue to support a newly separated proof-of-work version of the chain. Sun committed a part of his million Ether holdings towards the development of the so-called Ethereum proof-of-work network. Sun's Poloniex exchange has already listed ETHW futures, a product that allows traders to bet on prices of the token issued to Ether holders after the Ethereum proof-of-work network comes into existence. Futures exchange BitMEX today also listed ETHW futures nearly a week after it published a report on how traders could take advantage of the market reaction after the issuance of tokens. Quote, "I hope that whatever happens doesn't lead to people losing money," end quote, he said. A couple of outsiders basically have exchanges and mostly just want to make a quick buck, Buterin said. I agree with that. So I'm not expecting it to have a substantial long-term adoption. I hope that whatever happens doesn't lead to people losing money, he said, but obviously people will lose money in this particular case because unfortunately people aren't aware of how blockchain works and what you should be doing, which is control your own keys. And it is clear that you can't control your own keys for a futures contract on ETH proof of work. You can't. So don't participate in it. Once again, the idea of forking Ethereum to a proof of work chain sounds nice on the, on the surface level. But if we really look at it realistically, it's not going to be something that would go over smoothly at all. Just from the fact that for a chain to be successful, you would have to have developers running it. The amount of developers on Ethereum that keep the entire ecosystem running, from all the DeFi options to all the NFT marketplaces, etc., would not move over to the new chain. So you would end up with a bunch of dead tokens and a bunch of dead NFTs. And I don't think that that would be beneficial for the, the crypto community as a whole. I think you have to build anew. This is also why I prefer something like Ergo in general over something like Ethereum Classic, because Ergo is building something anew, right? They're adding new protocols. They are building their own DeFi. They are building their own NFT marketplaces, their own stable coins, their own assets. It makes more sense to push into a new project than it does to actually try to keep some sort of version of Ethereum around afterwards. This could, though, potentially cause issues with Ethereum in general for the merge. So you want to pay attention to what's going on with this because, there is this weird slight likelihood that the merge completely breaks the Ethereum chain. And if that happens and there is a forked version and it's newer than Ethereum Classic, the same reason we talked about the, basically Ethereum Classic's kind of position here, it could end up being that you have the developers just move over to the latest, most updated proof of work fork of the chain to continue their projects. That's a very, very, very slim chance, but that could be a reason for at least having that available post merge. So I think I had one more point, but I'm kind of losing my head on it. I can't remember exactly what we had. Other than, just once again, not your keys, not your crypto. Be extremely careful with investing in that. Now, what does the Ethereum merge, what will be the Ethereum merge impact on cryptocurrency miners? This is by News BTC. They say miners of both Bitcoin and Ethereum are still thriving regardless of the crypto winter. The revenue generated by Ethereum miners surpassed that of Bitcoin miners according to the 2022 record. The growth of miners is quite surprising given the increase in the cost of electricity, but all that might come crashing down very soon. There's growing concern that the upcoming merge will put Ethereum miners out of their jobs. This can be traced on the effect of the assets merge on the operational mechanism of the network. Get some water. Drawing from arcane research information, it was recorded that in 2022, Ethereum mining has been realized as a revenue of up to $11 billion. This figure is a bit higher than that discovered in Bitcoin mining. According to the research, Bitcoin miners have realized about $10 billion within the same period. The research data pattern is not different from that of last year. At the time, Bitcoin mining generated up to $17 billion. But again, the revenue figure generated was about 1 billion lower than that of ETH miners, which was at 18 billion. Bitcoin mining has been recording higher revenue compared to that generated through Ethereum mining. This was recorded as of 18 months back. Since then, the turn of events has been steady in the favor of Ethereum miners. The higher gain in ETH mining revenue is a result of its ecosystem versatility. However, there is about to be a change that could cost the jobs of Ethereum miners. That has to do with the upcoming Ethereum merge. This event aims to see the successful merging of Beacon Chain and Ethereum mainnet. Achieving this objective will trigger the move of ETH network to proof of stake. Ethereum miners know that the merge completion will end ETH mining. Also, all transactions performed on the ETH network will be taken up by validators. Moreover, based on the status quo of the proof of stake blockchain, these validators will be rewarded for every effort they make. There is an option for ETH miners to migrate to Bitcoin mining, but there is also a problem with the idea. That has to do with the mining system of both assets. While Ethereum miners use GPUs to perform their mining process, Bitcoin miners, on the other hand, use ASICs. This is also, maybe this article isn't going to give us what we need. I'll tell you that right now that we've already covered all of this. I thought maybe they would have some better insight, but it is clear that they do not. First of all, they have this completely conflated. The reason they can't migrate is because of the actual algorithm, not because of ASICs versus GPUs. Because technically GPUs can mine Bitcoin, but you don't mine Bitcoin with GPUs because the difficulty of the network is too high to be profitable. In addition to that, Ethereum does have ASICs on the network. So the amount of research put into this article is pretty poor, and I do not consider this to be worth continuing going through. Let's just talk a little bit though about the impact of the merge. And that is going to be obviously the amount of people moving off and the capabilities of other networks being able to handle that. So with GPUs, you're in a better position than you are with ASICs. If you have Ethereum ASICs, you have one coin to move to basically, and that's going to be Ethereum Classic. Now, luckily with Ethereum Classic, like we've talked about in the past, we do have a huge investment coming in from Antpool. Now, that could be a significant investment that ends up pushing Ethereum Classic into a position to handle enough of the ASIC miners to continue on, but it will really come down to the usability and how retail views Ethereum Classic, which is still up in the air and to be seen. At the end of the day, I think that this is the way it plays out. I think that there will be a huge flood of GPUs and ASICs on Ethereum ASICs specifically onto the used market, and most miners will shut down. But thanks to the way that blockchain functions and the way the market functions, eventually everything becomes profitable once again. So you have a couple options. You can sell off your Ethereum equipment right now, Ethereum mining equipment, and then buy back in when it's used and everything is crashing down. Presumably, if that all goes through as planned in September, which is yet to be seen as well, right? Or you can hodl you can hodl all of that silicon and equipment through all of it. Wait, you turn it off if you need to because you're losing money or whatever for a certain period of time, and wait until the dust has settled. And then you have the equipment to turn back on and start mining once it recovers. The market will adjust itself out, right? It doesn't need Ethereum to do that. Yes, there will be a lot less miners mining, but if you are one of the few that continues to mine through that, then you have gone through basically the worst shift, the most impactful shift in mining that's ever happened, and you are continuing to do it. And what I have found in life, just personally in general, is that the longer you continue to do things, the more success you will gain, even especially when things get really difficult. Does that mean go out and buy hardware right now? No, it doesn't. It's just basically those are your two options. Sell the equipment, buy back in if you want to continue, or just hold it and wait till the dust settles. And then there will always be something more profitable because the market will adjust itself out. There is a really cool website that was brought to my attention that you guys should check out called crypto51.app. Basically, it's the proof of work 51% attack cost on all of these networks. Definitely go check it out. It has a lot of information on it, and they have all of the information on basically how this is calculated, which I wanted to talk about. So in proof of work, cryptocurrencies, nodes typically are set up to recognize the blockchain with the most blocks and therefore the most hashing power. As the correct version of history, miners with greater than 50% of the network hashing power can take advantage of this by sending funds to one address on the main chain while sending the same funds to another address on a forked copy of the blockchain that they are silently mining with more hashing power than the main chain. Since other nodes only know about the main chain, they will see the first transaction as valid, and exchanges, etc., will accept this transaction as valid. This malicious node can later release these silently mined blocks, and other nodes will accept this as the new correct chain since it is longer. This will cause the original transaction to effectively disappear, and the nodes will recognize the funds as being sent to the address from the new chain instead. This is known as a double spend attack. Most bigger cryptocurrencies have sufficient mining capacity behind them, making it extremely expensive to acquire the necessary hardware to pull an attack like this off. Smaller cryptocurrencies have less hashing power securing the network, making it possible to simply rent hashing power from miners on services like NiceHash for a few hours, one of the reasons why we don't like using NiceHash on this channel. This significantly reduces the capital cost of an attack. Recently, there have been a number of 51% attacks, including one against Bitcoin Gold. So this is what I wanted to know. How is the cost attack calculated, right? So using the prices on NiceHash lists for different algorithms, we are able to calculate how much it would cost to rent enough hashing power to match the current network hashing power for an hour. NiceHash does not have enough hashing power for most larger coins, so we calculated what percentage of the needed hashing power is available from NiceHash. Note the attack cost does not include the block rewards that miners will receive for mining. In some cases, this can be quite significant and reduce the attack cost by up to 80%, and that is definitely relevant. So there are a number of possible solutions to reducing the risk. Proof of stake, which really just opens you up to a completely different validator process of an attack. Coins built on top of other networks, ERC20, which doesn't help the coins that are, or the blockchains that are trying to do it, and interchain linking, which interchain linking with Komodo is probably the best one. Komodo being an example, by the way. It's really interesting information if you guys want to check it out. An attack on Ergo, for example, would run you $68.85 million apparently, which seems pretty high, but possible, right? Anyways, let's get into mining profitability after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. The link is in the description. If you guys want to go check that out, definitely check it out. So mining profitability remains to be the same on the farm, around 4.5 gigahash a second, 4.39 gigahash a second over the past 24 hours, depending on the heat, etc. And that is coming out to 0.063 Ethereum or 107 US dollars. Now I do have 2 gigahash a second on Ergo, but that is on a solo node that I've built on in my farm. And in the first 48 hours, it has already hit a block. So on 2 gigahash, we got, yesterday, I think we generated another $100 in revenue, which is very nice, but we'll have to see how that works out over time. And building the Ergo node was extremely frustrating, by the way. So hopefully I can get it down to a process to show you guys, but it's a little difficult. Let's take a look at what to mine. We have Ethereum in first place at $3.17 a day after power, and then, and $2.40 a day after power. We do have the ProgPal coins corrected to 60 megahash a second and ZIL hash at 110 solutions a second. That puts Ravencoin in second at 229 a day in revenue. And Neoxa in third at 201 a day in revenue. Cero is at 266 a day before power and $1.87 a day after power. You have Fira at 262 a day in revenue and $1.87 a day after power. You have Conflex at 259 a day in revenue and $1.80 a day after power. You have Ethereum Classic at 246 a day in revenue and $1.70 a day after power. And you have Flux at 237 a day in revenue and $1.67 a day after power. And then down here, after the recently hacked Bitcoin Gold, we have Ergo, which is at $1.99 a day in revenue and $1.37 a day after power. Let's take a look at the hash rates on the networks. Bitcoin remains the same, around 234 exahash a second. Let's go ahead and take a look at Ethereum. And Ethereum is at 936 terahash a second, no changes over the weekend. Ethereum Classic is at 32.5 terahash a second, still remaining to stay right at where it's at with its recent price pumps. And that is probably pretty good news, to be completely frank. I usually was expecting Ethereum Classic to go back down, but is maintained over 30 terahash a second for going on its second week now, which is really good news. Let's take a look at Flux. Flux is at 1.13 mega solutions a second, and Ergo, probably all the same at 9.66 terahash a second. Mining pool profitability over the past 90 days, ZET in first, Ethermine in second, Crazy Pool in third. I did hear about some nefarious things that F2 Pool has been doing. Still working on a video for that though. Last 60 days, ZET in first, Ethermine in second, F2 Pool in third. Last 30 days, ZET in first, Nano Pool in second, Mining Pool Hub in third. Last 21 days, ZET in first, Nano Pool in second, Mining Pool Hub in third. Last 14 days, ZET in first, Nano Pool in second, Crazy Pool in third. Last 7 days, ZET in first, Nano Pool in second, Hivon Pool in third. Last 3 days, Crazy Pool in first, Flex Pool in second, F2 Pool in third. And for the last day, F2 Pool in first, Hivon in second, and Nano Pool in third. ASIC miner profitability We have the Antminer E9 still kind of in first place. They are getting shipped out at $63.50 a day. And check this out. Antminer L7 is at $39 a day on Verge. Verge, this one was surprising to me, but actually, Mr. Homie from Verge has been tweeting at me recently, so that's fun. What's that? Sunnerock. There you go. Boom. There's his profile if you guys want to go follow him on Twitter. But I didn't see this one coming. I don't know what exactly is going on with Verge. Verge has been around since the previous cycle. It has been, cranking along. It's a pretty good privacy project. It was one that a lot of people expected to kind of moon. It never really did moon necessarily, but it is there. They had all the same stuff back then that Dogecoins always had, which is like Verge to $1 and all that. But that is a pretty crazy profitability on that for the Antminer L7. The KD6 is at $23.70 a day. And the KD5 is at $15.14 a day. If we scroll down, the S19 Pro is at $5.79 a day. Let's get into questions and answers. It has to be a little brief today. Remember, super chats are never required, always appreciated, first to be read because they're the easiest to read. Super chat stickers boost the algorithm the most, so if you want to help there, you can do that. And supporting the channel directly to where I get the most revenue is best on sonofatech.locals.com. Let's get into questions and answers. Remember, if you want the question answered, to tag at sonofatech. All right. Seven Ho says, Ask Sonofatech, keep your head up. You got this. Just saw the last video from the other channel. Thanks for watching and for the kind words. Custom Computing says ETC is not close to ETH in terms of the code. There have been hundreds of updates on ETH. That is not the same development team as Ethereum Classic. There is no way to just switch dApps to ETC from ETH. Well, you have the same EVM capability, and they have been trying to keep up. That is why if you check a lot of their forks, they're pretty close. They are the closest. I did say that, of course, if you want the closest, you would fork, right? But I also don't think that that fork would end up being good because you're going to have a bunch of dead projects. Like I said, I think that you build from the ground up still. Like at the end of the day, you build from the ground up. Linus Sebastian says ETHW needs to be ASIC resistant. Otherwise, switching to ETC will be a waste of time because ASICs will dominate it. ETHW would not be ASIC resistant. They want their ASICs on there. Like, Antpool is not investing in Ethereum Classic, and Justin Sun is not trying to fork because they have a bunch of GPUs. Antpool, which is partnered with Bitmain, has a bunch of ASICs. That's what they have. So the people that are funding this shift, they're not GPU miners. The GPU miners, we're still on the same path. You're going to find another project to mine. Flux, whatever it is, right? Flux, Ergo, whatever it may be. Got 2 super chat stickers from Bojangles. Thank you, good sir, boosting that algorithm. Bruno says, Ask Sonofatech, trading 2 1660 supers for a 3060 Ti non-light hash rate. What do you think? I mean, I think it sounds like a fair trade for the most part. 30, whatever, right? 60 mega hash a second for 60 mega hash a second, and you're getting a newer card. Mining Pirate says, Ask Sonofatech, I building now an Ergo node for my pool. All right, Mining Pirate, good luck. Gabe says, Ask Sonofatech, do you have any hard data on cooling performance in your server chassis versus your old configuration? Just what we posted up on the vlogs, right? Mostly I was looking at it from a hash rate perspective, but because the environment can't be completely controlled, it's really hard to really look at it outside like pure temperature numbers, right? Daniel says, Ask Sonofatech, Newegg is having a shuffle today for things like 3080 and 3070. Does this mean this is another supply shortage? Just very odd. Not necessarily. I don't know why there's a shuffle necessarily. Do we have to worry about a shortage, though? And I think the answer to that is yes, we do have to worry about a shortage. There is definitely tension within Taiwan. And Taiwan, is 53% of the semiconductor manufacturing. So there is definitely worry surrounding potential shortages in the future. LZ says, at Son of a Tech, is there a possibility that the future of Polygon Matic is not tied to the fate of ETH? No, because it directly is meant to perform the scalability for ETH. Knowledge is Power says, at Son of a Tech, aka the host of the Crypto Mining Show. I just bought a 3060 Ti Founders Edition for MSRP. Did you make a good purchase? I don't do like bias confirmation. Like that's not... That's not what the channel's about. It's really like, do you feel like you made a good purchase? Clearly, like buying an MSRP is going to be great. The 3060 Ti Founders Edition is a great card. So, if I had to pick one, it seems like a good one to pick up. Purple Viking says, ask Son of a Tech, can you talk about your thoughts on privacy? What Monero versus Bitcoin versus ETH versus others do for keeping balances, transactions, and etc. private? That is a big question that we probably can't cover on this particular show right now because I don't have that time, right? We are at 11:08 and I got to get going. So sorry, that is a little too much for right now. Daniel Kemper says, ask Son of a Tech, not a question, just a statement. Appreciate you, man, and all your content. Thanks for watching, man. Think you're doing this the right way. Thanks for all you do for the community. Thanks for being a part of the community. Village BC says, ask Simon Tech, I wonder if they could fork ETH the same line CentOS did before RH took over, binary compatible for EVM, etc., to make project porting simple. I don't know that Justin Sun has that. I don't know. I think that the fork is a complete money grab. That's what I think. Andrew A., thank you for the $3 super chat sticker. And Paul, thank you for the $5 super chat. Says, you got a green backpack? No, my game kept freezing and I lost all my gear yesterday. We're playing a different game now. I'm mad. Thanks everybody for watching. I'm going to get to jiu-jitsu. We also have a live, it was supposed to be pre-recorded. But we have a live interview at 2 p.m. Central, 3 p.m. Eastern with Daniel Keller from Flux. And apparently they have an announcement coming up as well that will be on the channel. So tune in for that today. I know 2 live streams in a day is not ideal at all, but we're going to get you guys all the news we can get. So thanks for watching. Hit the like, comment, subscribe down below, and I'll see you next Tuesday.